All right, let's get right into it. I'm Steve, and welcome to today's Explainer. Look, if you've been glued to your terminal for the last 24 hours, you know exactly what we just witnessed. A classic, purely programmatic tug of war. We had mega cap tech taking heavy distribution on one side and an absolute rock-solid broad market defense on the other. High-frequency sell programs? Yeah, they spent the whole session just leaning heavily on a handful of overextended software giants. They were trying to shake out the weak hands, right? Trying to trick the retail crowd into thinking we're in the middle of some massive structural flush. But on this desk, we don't operate on fear, and we sure as hell don't trade emotional headlines. We track the hard numbers, the mechanical capital shifts, and the technical support shelves. So today, we are going to break down exactly how institutional capital anchored this market. Let's open up the hard ledger.
Now turn on any financial network right now, and the talking heads are practically screaming about the so-called tech wreck. That's the headline myth. Microsoft drops 2.3%, Oracle slumps 4.6%, and suddenly, the sky is falling. That is just noise. The hard ledger tells a totally different story. We're seeing incredible underlying institutional support defense. The broader index didn't even crack. It showed profound resilience. When you finally learn how to look past the heavy algorithmic selling in those top-weighted names, man, you see a completely different tape. So the absolutely crucial point here is separating the localized tech drag from the actual structural health of the broader market.
All right, moving on to Section 1, the Futures Scoreboard. Let's track the active derivatives tape.
I want you to shift your metrics entirely to the active forward cycle. Look at the September S&P futures, ticker /ESU26. Despite those massive tech-heavy headwinds, it absorbed the pressure flawlessly. It kept its structural composure to lock in a hard closing print right at 7,476 even. That right there, that is a disciplined defense of intermediate technical support. But look down the board. You see a totally different story in the alternative pits. Gold futures took a severe yield-driven liquidation, dropping 1.7% to settle out at 40.40. Bitcoin just got hammered down over 3%, testing psychological support at 60,000 on heavy ETF outflows. But notice how equities held their ground? Well, to understand how the S&P futures defended that 7,476 level while the metals and crypto pits bled out, we've got to look under the hood.
Which brings us to Section 2, the hidden breadth divergence. We've got to look beneath the tech drag. Because while the retail crowd is out there panicking over a sea of red tech tickers, look at this, 66%. Literally nearly 2 out of every 3 stocks in the S&P 500 actually finished the day in the green. Only 34% were in the red or flat. The major tech averages were leaking oil all day, sure, but the broader advancement line, it was rising. This is the divergence, guys. The index refused to fall out of bed because the selling was highly concentrated. It was absolutely not systemic. When you see breadth act like that, it tells you one very specific, very vital thing. Capital is not fleeing the system, it's rotating. Institutional desks are actively taking profits off the table from these wildly overextended AI valuations. They're stripping that risk out and they're deploying that size straight into the cyclical, transport, and homebuilder columns. Why? Because those sectors are heavily benefiting from the recent cooling we've seen in long-end treasury yields. Make no mistake, this is a healthy, mechanical capital shift, not a panic liquidation.
Okay, let's hit Section 3, the energy release valve, because physical markets always dictate corporate margins.
Down 3.8%. That is the massive drop we just saw in the physical Brent crude spot market. Now, our paper contract maintained its technical baseline around 91.89, and that's mostly due to ongoing diplomatic negotiations in Switzerland, basically a structural lag. But the front-month physical spot market, man, that tells a wildly bullish story. Global shipping intelligence just confirmed a steady increase in commercial vessels safely transiting the Strait of Hormuz with their transponders fully active. This return to physical normalization is exactly what's driving that 3.8% drop. So let's translate that drop in physical oil into hard corporate reality. What does it actually mean for us? It means massive operational relief. It effectively drives down logistics and overhead costs across the entire industrial curve. That right there is an absolute home run for corporate balance sheets. This is the underlying structural release valve keeping the equity bull market insulated. It gives equity buyers the fundamental confidence they need to step in and fiercely defend that 7,476 future shelf. They know the cost of doing business just got cheaper. It's really that simple. Let's pivot to Section 4. The Berkshire Safe Haven, or what I like to call value-driven rotation in action. Take a look at Berkshire Hathaway Class B shares. We got a firm green close today at 494.81.
While all those high-flying tech assets were facing steady distribution and aggressive algorithmic selling, Berkshire put in a stellar performance. It completely, and I mean completely, defied the broader tech distribution pressure.
And here is why. Berkshire's massive cash moat acts as the ultimate index stabilization valve during periods of tech multiple contraction. This is the pure institutional mechanic at play. Look, when macro fund managers anticipate a choppy pre-PCE environment, they don't just dump everything and go to cash. No, they park massive size into cash-rich balance sheets that do not rely on speculative multiple expansion. Berkshire allows these institutional desks to keep their equity exposure locked in without absorbing all that high beta growth volatility from the software giants. It's brilliant. It's a defensive, value-driven rotation executed to perfection.
All right, bringing it all home with Section 5, Professional Trading Directives. How to manage your risk in a high-volume rotation.
Listen up, because here is your actionable blueprint for managing risk in a high-volume rotation. Rule number 1, stop trying to guess the direction of individual headlines. It's a losing game. Let the hard technical boundaries dictate your risk. Rule 2, watch the upward-sloping 50-day exponential moving average. Today's extremely successful defense of the 7,476 floor proves market makers are fiercely protecting that primary line in the sand. As long as that 50 EMA holds on a weekly closing basis, the primary bull market architecture is structurally safe. Rule 3, keep your position sizing tight. We are right in the middle of a rotation, which means chop. Expect chop. And Rule 4, avoid over-leveraging into individual tech names before tomorrow's critical personal consumption expenditures data. Honestly, just wait for the verified data to drop before adding leverage. Let the verified levels do the heavy lifting.
So ignore the noise and trust the technical defense we witnessed today. The ledger is locked. But the real question you gotta ask yourself is this: when tomorrow's PCE inflation data hits the wire and volume spikes, are you gonna be sweating the headlines, or are you gonna be executing from the ledger? Review your levels, check your sizing, and stay absolutely disciplined. I'll see you on the desk.